The majority of the stock market today is red, as we can clearly see. Now this brings up a very strong opportunity to buy some very good undervalued dividend stocks, and in today's episode we are going to run through 4 of them that we don't hear about a lot. Each one is right there, as we can see, towards their 52-week low, and we have a lot of significant upside from Wall Street and their price targets. As always, we will run through each one's historical performance. We're going to touch upon their dividend safety, look at some important metrics like the free cash flows and their debt levels, and we'll run every single one of them through our own valuation model, getting to our intrinsic value, getting to our acceptable buy price, remember incorporating our own margin of safety, and looking exactly at how much Wall Street is targeting for the upside over the next 12 months. Now the first one that we are focusing on today, it is Papa John's International, and interestingly, we get a hold rating from Seeking Alpha, a buy from Wall Street, and a sell from Quant. So let's dig a little bit deeper. Again, as we mentioned, all stocks right there at their 52-week low. This is one that has a forward yield of around 3.86% and a forward P just under 20. Bear in mind, S&P right now around 22. And we do note over the last 12 months, it has been obliterated, down 36%. And if you go as far back as 10 years, it is up only around 10%. We do see all-time highs nearly 3 years ago, $132. So we can see the share price has fallen dramatically since then. So let's take a look at this in more detail. As we said, market cap 1.57 billion. It is a small cap company. And when we take a look at their dividend growth, this is what we love to see. Double-digit increase over the last full year, double-digit increase over the last 5 years, and over the last 10 years, we do see 22% increase year on year. So already off to a good start. When we take a look then at some of the financials, first thing to note, for dividend safety, we do focus on free cash flow. Remember, earnings susceptible to manipulation by management through their accounting. And as always, we do get to identify potential dividend cuts through this metric. Now, red flag indicator, we get a signal in 2022. What this indicates, 139%, meaning that management paid out a lot more in dividends than they generated in free cash flow. Positive to note here is that in 2023 and 2024 expected, it is looking to come down significantly, and one of my own metrics is around 60% or less for the free cash flow payout. That then does give me faith that they can continue to offer those double-digit dividend increases that we can see Papa John's have been doing historically. Then we move on to the free cash flow per share. We do want to see increases to this year on year consistently. What we do know though, however, with this company, very inconsistent. 117 in 2013, 111 in 2022. 2023 anticipated around 260, 2024 an increase. So positive news for the future. It is expected to increase year on year. So that is nice to note, given this company is towards its 52-week low with also a forward yield of nearly at the 4% level. Sales growth, interesting to note, a little bit inconsistent. Typically 3 to 7% is what we do target just to keep up in line with inflation, 3 to 4% at a bare minimum. 2020, 2021, very strong. 22, it did drop down to the lower levels on a trailing 12-month basis at -1%. So very mixed over the last few years. And when we do look at it numerically, what we can say is their top line has increased by around 50%. Very nice to note they've been doing those share buybacks, reducing it from 44.2 million to around 33.8 in the more recent year. This means that they are returning excess cash to your pockets if you are investors, as you then gain a larger portion of the company. Now, very important to note the ROIC, as always, one of our 7 golden dividend metrics here. 10% or more, just to give us faith management are able to effectively allocate their capital, and they've pretty much done that. Although a little bit inconsistent in the more recent period, they've done that nearly every single year. Last 2 years looking very good, trailing 12 month 27%, also looking very positive. Now, operating margin, ideally what I want to see around 16% or higher. Very inconsistent, but in fact over the longer term we do see around 7 to 9%. So this is something that is been going on for Papa John's over the longer term. Just something we would ideally like to see go into the double digits. So one to note for the future annual reports. And the free cash flow margin, 5% as a minimum, and we can see again a lot of inconsistency, 4% on the trailing 12 month. So one thing we do note with PZZA is that there is inconsistent themes throughout. Now, the net debt to EBITDA, the earnings before the interest, tax, depreciation, and amortization, this correlates to both dividend safety, balance sheet strength. We want a maximum of 3.5. These are the number of years it would take the company to pay off all of that debt net of cash on hand. For the large part, it is below 3.5. 3 in 2022, trailing 12-month 3.8. It is anticipated to come down to 3.49, but that is pretty much at the upper end of what we want to see. So again, just something to consider into the margin of safety. Now let's jump into the valuation model. As always, if you do enjoy the content, value is being provided. Do smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. And as always, deep dives, we run through every single model. Today, let's get straight into that intrinsic value. And what we arrive at in today's price is $79.42. Current trading price significantly lower. Margin of safety then, we always start off with 10%, and remember we only execute on that for high quality companies that meet our 3 golden criteria: a wide moat, strong financial metrics, and good forward looking data. So if you believe that, a buy up to $71, then we keep going till it's near the current trading price. And what we can see in today's episode, it is pretty much trading at a 40% margin of safety. Now you could argue there are a lot of red flag indicators throughout our analysis at a very high level, but again it depends whether or not you believe it warrants a 40% margin of safety or if you need to see a little bit more. In terms of Wall Street, well, they believe the share price will go up very high, lower than our intrinsic value, but still, they see implied upside of 48%. Their price target is $71 for this company that has been beaten down over the last year. As always though, do let us know your thoughts about these stocks as we go on, whether or not you're adding or maybe they're now on your watch list. Now before we jump into the next stock, just to let you know, we've released our latest free weekly article around super investors and their buys and sells. We also got other articles all completely free, instant access by clicking on the pinned comment below. 20 undervalued stocks to consider for the portfolio, websites and resources on how we identify undervalued stocks. Next one we're taking a look at is Jack in the Box. Again, hammered down 40% over the last 12 months. And we notice a buy rating from Wall Street, a double hold from Seeking Alpha and Quant. And as we said, right there at their 52-week low. Forward yield over 3%, 3.28, a forward P that is very low, 8.46, but again we have to compare it to what the sector is looking like, and as we can see, over the last 10 years it is down around 5%, all-time highs do sit around that $120 mark, although we are talking about 3 years ago today. In terms of dividend safety, well, we don't have a score market cap, it is a small cap company around $1 billion, and when we do take a look at some of the metrics, dividend growth, well, they haven't increased it over the last year. Over the last 5 years, a little bit slower, just 2% year on year. And when we take a look at some of these metrics, the free cash flow payout, pretty much lower than 60% over the majority of the last 10 years, 26% in the more recent year. 2024 expected to come down, so hopefully this year we do see a nice increase to the dividend, and hopefully that does help also alleviate some of that share price pressure, or in fact downward pressure it has been facing. Free cash flow per share, well, pretty much doubled over the last 10 years. It is increasing, not massively inconsistent either, and we do note over the next 12 months it is anticipated to increase nearly double, so a very good sign. Sales growth, they did go through a period 2016 to 2018 where it was very low, double-digit negative growth. Since then, though, looking very strong just the more recent year, 15%, so this could be one that is definitely under the radar, but we do note it did drop from $1.48 billion in 2014 down to $870 million before pretty much picking up into 2023. On top of that, they've pretty much half those shares outstanding, so that is a very nice thing to incorporate when you are considering companies. Yes, you could argue they haven't increased the dividend, but this is also returning excess cash in a different way to your own pocket, so I would say this is a nice positive to note. ROIC has been decreasing over the longer period, although the last 3 years still within that 10% range that we do like to see as a minimum. 10% also noted on a trailing 12-month basis. Margins, remember from the previous stock, 16% or higher. Now again, it does straddle around that consistently over the longer term. No real efficiency, no increases over the longer term, so just something to think about. 15% in the more recent year. Free cash flow margin, it does look positive, higher than the 5%, but we do notice on a trailing 12-month basis, it has dropped down to 2%. Net debt to EBITDA, now for these type of companies, we do incorporate 5.5, we do bring it up. We can see 5.16 in 2023, 5.47 in 2024 anticipated, so it is pretty much around that level that we want to see as a maximum. Again, some of these things are just to consider whether or not these fit into your profile and your portfolio as an investor. In terms of the valuation, well, also don't forget you can grab a copy of this valuation model to get to both intrinsic value as well as your own acceptable buy price by clicking on the pinned comment below, and you can get access, put in your own companies or those on your watch list. So a 10% margin of safety, you buy up to $61.54, 15% up to $58, and at 20% pretty much at the current trading price. So for Jack Jack in the Box, ticker symbol JACK. It is a 20% MOS. Remember, these are based on our estimates and judgments. In terms of Wall Street, well, they believe the share price will be higher than our intrinsic value that we've calculated, 32%, so they do believe this is one definitely at a minimum just to consider and do your own due diligence. But don't forget, as always, let us know your thoughts below. The next dividend stock that we are taking a look at is the JM Smucker company. We have a buy rating from Seeking Alpha, a double hold from Wall Street and Quant, right there at their 52-week low, and we can see very similar to Papa John's, a 3.86% forward yield and a PE on a forward basis of 11.44. Over the last year, again, hammered down 27%. Over the last 10 years, however, it hasn't performed that great, just up 6%. Although bear in mind, these numbers don't include the reinvestment of that dividend, and we can see all-time highs around $163, around 60% from the current trading price. Now, when we take a look at the dividend safety, nice to note, 80, it does look to be safe. Market cap just under 12 billion. It is a large cap company, and it was just reaffirmed a couple of weeks ago that their dividend cut is looking very unlikely for this company. Now, the last recession, in fact, they increased the dividend during the 07-09 crash. They had positive recession sales, which was above the average of the S&P, coming in at -12, and they also significantly outperformed the S&P, -27, with their S&P bringing in -55. Now, they did increase that dividend 3.9% in July last year. As always, on this channel, we do target a minimum of 4% just to keep up in line with inflation. So it was nice to note nearly, or at a bare minimum, around that level. Over the last 5 years and the last 20 years, mid to high single digit increases, and we can see they have been increasing those dividends for 21 years in a row, whilst also paying a dividend for the last 51 without a reduction. Now, dividend yield theory, for those that are new to the channel, it does state a company is undervalued when the current yield sits above the 5-year average. So a signal of undervaluation here, a double undervaluation signal. The forward P pretty much the lowest it's been over the last 5 years. 10.9 versus 14.5, and we also note it is a lot lower than the consumer staples of 18.5. Now, in terms of the payout ratios, as always, below 60%, although if you want to be industry specific for consumer staples, we heighten that to 70. Now, it's been pretty much below that year on year, 49% expected into 2024, so hopefully we do see an above inflationary increase this July. In terms of free cash flow per share, well, it has increased over the longer term, but very inconsistent, but we can point out to the next year where an increase is anticipated to around 867. Inconsistent, again, another theme for this company, 3 to 7%, but pretty much every other year at 0%, which is quite interesting to note. Trailing 12-month, -1%, and when we do look at it over the longer term, they have increased their top line around 50%, but very minimal growth in some year periods, as we can see. In terms of shares outstanding, they've done both share buybacks as well as share issuances. Funnily enough, the number of shares outstanding in 2014 is the same number that they do have on a trailing 12-month basis, but they have in between both done share issuances and share buybacks. When we take a look at the ROIC, it is below 10%. Again, industry specific for ROIC, we can lift that up to 12%, but it has been consistently around the 8 to 10% level, 9% in the more recent year. In terms of margins, while consumer staples, it does straddle around that 16%, 17 on a trailing 12-month basis, but the free cash flow margin does look healthy. It is above 7%. Remember, we heighten this as well for consumer staples, 8% on a trailing 12-month basis as well. In terms of the net debt to EBITDA, then below 4 is the target here. Pretty much lower every single year, 1.95 in 2023, but we can see a massive increase expected to 3.99 in 2024. So again, lots of things to consider for that margin of safety. So the intrinsic value for SJM in today's episode is arriving at the average of these two at just under $140. Now, margin of safety then, 10% a buy up to 125, at 20% around 112, so not that far off. 25% it isn't quite there yet, so somewhere between a 20 to 25% MOS level in today's episode. What we also see is Wall Street believe the share price to be not too far off our intrinsic value. They do see 25% upside over the next 12 months. Let us know if this is one that has been on your radar, or maybe it isn't for whatever reason. The next dividend stock that we are taking a look at is Robert Half Inc. Now, we do get a triple hold. This is one that is right there at their 52-week low. We do note a forward yield above 3%, 3.19 to be exact. A forward P pretty much in line with the S&P, down around 2.5% over the last 12 months. Over the last 10 years, whilst it is up around 42%, it has come down significantly from all-time highs, pretty much double the current trading price that we see today. Dividend safety, well, 96, very safe, so that is looking very good. Around 7 billion, a mid-cap company, and we can see that this dividend safety score, very safe, it does suggest a dividend cut is highly unlikely. Last recession, well, they increased the dividend. We see below average growth, but pretty much a near S&P return. When we take a look at dividend growth, well, this is what we love to see. Double-digit increase this year, double-digit over the last 5 and 10 years. So we're off to a great start already, and we can see 19 years of consecutive increases. Remember, companies become dividend aristocrats when they do have 25 years or more of those consecutive increases to the dividend. We have an undervaluation signal on the yield at 3.18, but we do note the forward P does sit higher than the 5-year average, and it does also sit marginally higher than the industrials of 19.4. So when we take a look at the free cash flow payout, we do notice consistently below 60%, although it is anticipated to rise to 50% in the next year, but still no worries noted. They should still be able to offer those very nice dividend increases. When we look at the free cash flow, pretty much more than doubled over the last 10 years, looking like moving in the right direction as well, though we can see a drop is expected into 2024. Sales growth, well, very mixed. The more recent year, in fact, double-digit negative growth, negative 12%. We also, in fact, saw that in 2020. In between that, though, we did see double-digit growth, and over the longer period, we can see around 50% growth from 2014 to 2023. Similar to the previous companies, they also do those share buybacks. As we can see, they have reduced a fair amount, buying back around 31 million over the last 10-year period. ROIC, well, some very high numbers that we see, although it has reduced into the more recent year at 25%, but overall looking very good. These high ROICs consistently as well do make them attractive to potential investors. Operating margin, well, straddling around the 12%, although it has lowered significantly in 2023, definitely something to keep an eye on. Free cash flow margin nonetheless, in fact, been increasing over the longer term. That is a positive sign. Nice 9% over the last 3 years as well consistently. Now, this is probably one of the best parts about the business on the net debt to EBITDA, 0 across the board, or at least over the last 5 years, and projected into 2024, essentially meaning that it won't even take them 1 day to pay off all of that debt net of cash on hand. A very strong balance sheet. Now, the intrinsic value in today's episode, the average of these three, just over $100, with a share price significantly lower, as we can see. Margin of safety at 10%, a buy up to $91, 20% up to $80, and we can see another company with a very high MOS level, pretty much touching a 35% margin of safety as of today's episode. And when we do take a look at the Wall Street forecast, they do see around 21% upside. They do see this around $80 over the next year. As always though, do let us know your thoughts. Papa John's, Jack in the Box, SJM, as well as Robert Half that we have just covered now, whether any of these are ones that maybe you hold, maybe on your watch list, or maybe after today's episode for whatever reason they aren't ones you are looking at. As always, if you enjoyed today's episode, value was provided, smash that like button, hit that subscribe and bell button so you are notified when we drop these videos. As always, drop us your thoughts. We'll see you all on the next one, and for now, take care.